Today we will break down the Relative Strengths Index, or as it's known in our trading community among the traders, the RSI. One of the most popular, used, I would even say loved among traders, technical indicators. Very simple, very user-friendly, very easy to use, and great way to confirm your trades, find reversal spots, reversal trading opportunities, and many times even to join ongoing trends. So what is the RSI, the Relative Strengths Index? Where do you find it? How do we use it? Let's break it down. So first of all, you go to the indicator section, of course, and under the category of oscillators, you would find the RSI right here at the bottom. You click on that. By default, it comes with a period of 14 and applies to the close price. You can, of course, choose the visibility and the style of your line, as well as the thickness. Choose the visibility on what time frames and what chart types you want. And by default, it comes with the level of 70 and 30, which help to identify overbought and oversold conditions. And if you want to change it, I personally love the 80-20 for more extreme points, but by default it comes with 70-30. And you click OK. This would be the RSI indicator. By its original purpose, it was created in a purpose to help traders to find reversal spots, especially in ranging markets, because when the market is on steroids and just moves in a huge momentum, the reversal spots could be, let's say, fake. But when the conditions are slower and more technical and more ranging, the RSI is absolutely perfect, especially when it is combined with other technical methods, and of course the price action. So the RSI works on a calculation of recent gains versus recent losses, and gives you the output, which moves in a scale between 0 to 100, while anything above 70 is considered to be overbought. Anything below 30 by default considered to be oversold. For more extreme points, I love using the levels of 80 for overbought and 20 for oversold. So you can see here examples. It works perfectly again in slower and more measured ranging market conditions, and when you are with the trend. So for example, if it's a bearish trend here, then oversold conditions would be greatly see here. Of course, for overbought, you would find here on the bottom examples when it is going below the 30 and gives great indication for potential reversals here for the overbought as well. So besides the 70 and 30, there is another level which traders like to use. This is the level of 50. And if you go back to the RSI indicator, and on levels, you can add a level. For example, let's add 50 and let's choose white color for the visibility. Yeah. What traders love to do in that case, especially when you go with the trend, like in our case, you can see sequence of lower highs, lower lows. Then when you have pullbacks and then the market goes down again with the original trend, when the price goes below 50, it gives a great indication for a potential continuation of the trend. So these are the main uses of the RSI, while there is also another a little bit more advanced approach to find divergences. That happens when the market and the indicator show opposite direction. The oscillators sometimes help to spot the trend changes, trend reversals before they actually happen. And the way to spot that is to compare highs and lows of the trend. And when you see that in opposite directions, you get indication that things might change. For example, let's take a look on this uptrend sequence of higher highs, higher lows. And when you compare the highs on the chart with the highs on the RSI, you would see that while the market, the price, the highs go up, the highs on the RSI go down, indicating a bearish divergence, indicating that something might happen behind the scenes and the trend could actually go and reverse.